Yeah, I've been chasing the global trade for a long time, and I would argue, sadly, that globalization probably peaked at the great financial crisis. And when central banks around the world, first of all, had to protect jobs on a sovereign level more than they cared about efficiencies, we had the public sector bail out the private sector. Global trade as a percentage of GDP peaked in 2008, and we've been fighting that. You talk about the pandemic. That obviously was a case where look at our drug companies, look at our healthcare system, look at the way that the U.S. and Europe were vaccinated first. Look at some of the dynamics around then China with their Made in China 2025. That's not about let's broaden and diversify our economy. It's let's protect China and put China first in terms of the global internet and cybersecurity and making sure that China is not on the wrong side of nanotechnology. So we've seen this for many years, but Russia-Ukraine is a sad reminder about strategic important sectors.
So how do you invest for this new global world order, or de-globalized world order, if you will?
Well, clearly there are negative consequences. A lot of the inflationary dynamics that we see in the world are ones that we thought were a function of COVID or supply chain dynamics. But some of it really, again, started where we have seen the global economy become much more regional. I think there's higher inflation. I think there's going to be a case where investors need to find those strategic sectors. I think in terms of multinationals, they will be more exposed. And if you look at small and mid-cap companies, they will outperform, I believe. And I believe they've actually outperformed over the last 15 years or so during this period where globalization has kind of peaked. So strategic sectors, obviously the energy sector has been front and center. And as much as people think that this is a trade and that oil will be lower by, whether it's 6 or 12 months out, the lack of investment in the energy sector means that there are structural reasons why oil prices stay high. The energy sector as an investment is, the energy sector is less than 4% of the S&P and of the S&P 500. And if you think about where energy peaked in the financial crisis, it was close to 16%. I think this trade's on your side. Obviously, the uranium trade specifically around energy, URAs and ETF, CCJ, both things I own. I think the defense sector obviously also brought into front and center. And then regionally, I think Mexico, for example, is a major beneficiary of outsourcing, but regional outsourcing. Also, they are an oil economy still, and I think there's a lot to say about that.
Yeah, nearshoring, at least where the U.S. is concerned, which sort of raises the question. You got central banks tightening around the world. You got high inflation. You got a strengthening dollar. And then, of course, you've got this reorganization of supply chains. Where does that leave emerging markets more broadly?
It's tough. I think investors need to be more, need to not seek out the EEM or the VWO as ETFs to get the entire asset class, because that's 40% China. And maybe China has bottomed. But I think owning the EWZ or owning Brazil, EWW, Mexico, is the way to invest in emerging markets. As someone that's been an emerging market investor much of his career, I'm not happy to see that if you invested in the EEM versus the SPY over the last 15 years, you've continued to make lower lows. So I think you have to pick your parts of this trade because there is higher growth. There are demographics. EM is not dead. In fact, I just think you have to be a lot more selective than taking a proxy play approach.
Tim, it's great to see you. Tim Seymour.
Thanks, Morgan.